Very good morning. These are the top business stories live from the Sky Newsroom. Scrapping the standing charge. We'll speak to Energy UK on the regulator's plans to shake up how we pay our bills. Red tape mayhem. We'll be talking about how the new EU customs rules are putting off small businesses selling to Northern Ireland. Plus, do you believe in the Santa rally? Find out why investors are betting on the magic of Christmas. Yeah, I might not have Christmas songs, but we have got some festivity on Business Live this morning. Welcome to the programme with me, Dhara McCaffrey. We're going to begin, though, with energy because Ofgem has announced new plans to force suppliers to offer tariffs without standing charges. Now, standing charges are added to the daily fees that we all pay that cover the cost of connecting an energy supply to us. Let's speak to Tim Jarvis, Director General of Markets at Ofgem. Very good morning to you, Tim. Just explain what you are setting out today in regards to these standing charges.
So what we're announcing today are proposals to ensure that all customers, regardless of which supplier they're with, will have an option to pay for the costs that currently go into their standing charge through their unit rate. So at the moment, the way the price cap is structured is that the standing charge is set in the price cap at around £300 a year for a dual fuel customer. But in the future, what we want to ensure is that customers will have a choice between whether they pay that through a standing charge or whether they put that onto their unit rate.
And the big point is, I think you had a consultation on this. 30,000 people got in touch, most of them wanting to see the standing charge removed. What's the justification for the standing charge? I think for the average household, it's around 300 quid a year, not an insignificant sum of money.
Yes, we had a huge response to our consultation, as you say, and I speak to customers a lot about this, and it comes up a lot in my conversations with customers. I think it's important to note that the costs that go into the standing charge are the costs of actually running the system. They're the wires and the pipes to people's houses. And it's the costs of billing and it's the costs for the suppliers that run the system and charge us for our bills. So we've been clear from the beginning, we can't make these costs go away. But what we can do is help customers choose how they pay those costs, and that will work differently for people depending on how much of their energy they use, about whether it's better off for them to have a lower standing charge or to have a higher standing charge.
And in theory, Tim, this would help people who don't use an awful lot of energy, and so in theory they would pay less throughout the year because if it was related to how much energy they use rather than just a fixed sum, they might be slightly better off. Who are the losers then? Because, you know, you and I have been around long enough to know if there are winners, there are always losers.
That's right. I mean, however we cut this up. Now, the challenge we've got is that the people who we are particularly concerned about are people who can't safely reduce their energy. So if we've given examples today in our publication, but we have talked to disability charities, there are many people who have health conditions which require them to have their heating on more often, or they might have medical equipment that uses energy. Now, the risk is that if they're on a low or zero standing charge, their costs will go up significantly overall, and we need to avoid that, which is why we're not making a switch for everybody and trying to ensure that that all customers have a choice and we can help them move on to the right tariff for them.
And Tim, I think ideally, you would want this potentially to come in from next winter. What is this suggestion that actually some unpaid bills up until date might be written off? Is that a possibility, or what does that relate to?
So what we're looking at in a separate consultation today about the costs of debt in the energy system, what we've seen during the energy crisis and the associated cost of living crisis, was that despite the large amounts of government support that went out to the system, many people were struggling with their bills, and we've seen debt go up significantly. So it's gone up 90% over the last 2 years. It's now about £3.8 billion. A lot of that debt is sitting with customers who struggled during the crisis, couldn't afford to pay their bills. What we're looking at is, can we find a way of targeting support in the system, the money that already goes into the system, to help those customers, help them bring that debt down and bring them back into the system. 3/4 of the people who are in debt with their energy supplier do not have a repayment plan. So we need to move those people back into the system, because that is not just difficult for them and obviously really stressful for them for carrying that level of debt, but it also puts more costs into the system, and that puts more costs on all our bills.
Tim, Jarvis there from Ofgem, thank you very much indeed for joining us. Thank you. OK, well, that was the view of the regulator. What does the energy industry make of it all? Let's speak to Dhara Vyas, who is the Chief Executive of Energy UK and joins us. Very good morning again to you, Dhara. Just on this question of whether you think this consultation, this plan from Ofgem is a good idea, what is the response from your industry?
Good morning. Thanks for having me on. I think we need to look at Ofgem's proposals in more detail. I think that the addition of a zero standing charge option will significantly change the nature of the price cap. It's important to remember that the price cap was introduced to protect people who choose not to switch, who choose not to engage in the market. And there was something called the loyalty penalty, where people who weren't switching were paying too much. The price cap came in and it protects them whether they shop around or not. So introducing a new price cap, which has not got a standing charge, and expecting people to choose between them is going to be tricky, because we're expecting them to engage and choose. So we need to look at the details and see exactly what it is the regulator's proposing here.
So what you're saying, that it's kind of going to have to rely on people making decisions that you just don't think will just involve a lot more effort. Is that your point?
It's not about the effort, it's about the complexity in making this choice. As Tim was saying to you earlier, and I only caught the end of it, ultimately, if you have a tariff which doesn't have a standing charge, it means your unit rate is higher. And, the way we use energy in our homes, it changes depending on what's happening in your life. If you're sick, you're at home more. If you have young children, if you're energy dependent. So I wouldn't want anyone to think that a tariff that doesn't have a standing charge is better for them. If they end up using more energy, it could end up working out more expensive. So the risk here is it could be expensive for some households, particularly if they're in vulnerable circumstances. So I'm really keen to make sure we're working closely with our customers, with the regulator, so that if this does come in, we're really clear about how it could work.
So is this about kind of shuffling the pack rather than any real significant change? It just means that around the edges, some people might pay a little bit less, some people may pay a little bit more, that this is actually not the significant change that maybe the energy sector needs?
Look, I think lots of people do feel like it's unfair to pay these daily standing charge prices. Important to remember that the standing charge pays for fixed costs that are incurred in the supply of energy. They don't go towards profits. They are the fixed costs that are in the system, and they're passed on through the suppliers, because the suppliers are the ones who hold the relationship with the customer. And they remain fixed regardless of how much people use. They're very high right now. We've got a lot of network costs that are being passed through. About 60% of the standing charge is network costs right now. We know that this is a problem. It's important we're having this conversation. I don't know yet if a price cap without a standing charge is the right.
And just finally, Dhara, you and I have talked about this before, haven't we? The enormous debts there is, particularly amongst households when it comes to energy. I'm sure you got Tim's response on that idea of trying to maybe write down some people's bills. Again, is that something that you guys welcome?
We do welcome that. Look, suppliers have pledged over £500 million of support this winter, and we know it's just not enough. We're working with government. Main focus for us is how do we get the data we need so we can target support and get a long-term response in, but something to help us with debt is going to be really important.
OK, Dhara, for the time being, thank you very much. I don't know whether I'm going to surprise the gallery here and say, can we go back to Tim, who I think has been listening to this chat, and see if he has got a response to what he heard from the energy sector there. Largely been welcoming of what you guys are trying to do today.
Yeah, look, we need to work with the energy sector in the same way we need to work with consumer groups on all of this. I mean, I think the important point is that we want to make sure that customers have got choice and that they've got options that work for them. Now, that also means making sure that they've got the right information so that they know what's right for them. And as Dhara said, people's circumstances change. So we need to look at this quite carefully through our consultation to make sure we get the right information for people. But I do think that what we have heard overwhelmingly from people through this consultation is that they want more control over their bills. They resent the fact that they're defaulted onto something which requires them to pay something every day, regardless of their usage. And for some customers, it's going to be much better for them to move to a different way of paying and a different type of tariff. And we want to make sure they've got that option.
OK. Tim, again, appreciate your time this morning. Thank you very much indeed. Thank you.
Thank you.
OK, let's talk now about exports, because a large number of small British businesses have stopped selling goods to Northern Ireland as well as Europe as new EU custom rules have come into effect. Many smaller firms say the new requirements are simply just not sustainable. Despite not being a member of the EU since January 2020, Northern Ireland is subject to EU rules due to being part of the single market and indeed the customs union. That's part of the tariff-free bloc of the European Union. Well, let's speak to the owner of a small business. That is Johanna Haughey-Lewis, who is the founder of Weirdstock and joins me now. Johanna, thank you very much indeed. Just explain to our viewers, many of them will be entirely unaware of this. What are these new changes and why are they having such a significant impact?
Hi, Darren. So the new GPSR regulation, it's a safety regulation introduced by the EU, and it requires really detailed safety testing documentation for businesses that are non-food products. So any homewares, fashion, beauty, and there is very limited guidance on this. So that is one problem for small businesses. The second element of this is that businesses are required to have a responsible person based in the EU, in the EU, and this is quite a costly requirement and really unfeasible for a lot of small businesses.
And what it means fundamentally is that businesses here in Great Britain, if you like, are simply saying we cannot afford to, or we cannot comply with these rules, so we're just simply not going to sell to Northern Ireland consumers.
Yeah, that's true. So I'm hoping myself that this is going to be a temporary measure. But for the moment, this sort of compliance officer that is required, they're charging a lot of businesses per SKU. So if you have, I have a homewares brand, I have a bedding brand, it will be multiple sizes. So that's all of my SKUs. It's the same for a fashion brand. If you've got one product, 6 sizes, you've got all of these really high costs. It's just unaffordable. Also, the communication and the information that's been available for this has been super limited, and it's been almost impossible to have it ready on time, even if I was able to comply and have it ready on time.
And Johanna, I'm old enough to remember when we were told that actually Northern Ireland was going to get the best of both worlds, access to the markets in the United Kingdom and also access to the EU. Has that simply just not happened?
Well, for me, it's incredibly disappointing. I'm sure you can tell from my accent that I am from Northern Ireland. I'm from County Armagh, although my business is based here in London. And yes, it's really frustrating for me. And it was a surprise to me whenever I found out about this. Obviously, Northern Ireland is still in the single market. But for small businesses, unfortunately, Northern Ireland are not going to be able to receive products from a lot of small UK businesses now because it's just not possible for them. Because of the sort of retro aesthetic of my brand as well, I have a lot of small business friends and community who are vintage sellers. For them, it's even more challenging because of the level of SKUs. They have one-of-a-kind products. It seems incredibly unfair that this is happening to small, sustainable businesses. I think I can see the reason behind this new safety legislation. It's really to crack down upon the influx of low-quality, dangerous goods that are coming from these huge fast fashion retailers and producers. But unfortunately, it's having this knock-on effect on the small and sustainable businesses.
OK, yeah, no, it is, and they're not ideal in the run-up to Christmas, certainly. Johanna Haughey-Lewis, thank you very much indeed for your time this morning with the most fantastic backdrop we've had for quite a long time. What wallpaper that is. Thank you, Johanna, thank you.
Thanks.
Well, speaking about Christmas, as it edges closer, you may hear the Santa Rally mentioned. So what is it? Well, it's the idea that there is a sustained increase in the stock market that occurs around the festive period. There are a lot of theories out there as to why it happens, but does it mean you should think about investing over the holidays? Let's speak to Jonathan Webster-Smith, Chief Investment Officer at Bowmore Asset Management. Very good morning to you, Jonathan. So is this a real thing, this Santa Rally?
Is it a real thing? Well, it looks at the last 5 trading days, last 5 trading days of the year, and the first 2 in January. And if we looked at the we looked at the numbers over this last 73 years to the end of 2022, the US, the market's dropped 78% of the time. The last 6-day average being 1.3, and against that of the rest of the year, the actual average is 0.2. So quite clearly, there is something in the numbers that tell us that. The UK also hasn't missed out, being up 3 out of the last five years. And it was first identified by Jarl Hirsch in 1972. But of course, just worth saying, there are some tough years, so it's not all positive. 2018, of course, it was down 10.7. So,
and Jonathan, do we know if it is a thing? What's behind it?
Well, if it is, I mean, is it a thing? Who knows? It's a bit of joy around Christmas time. But really, the underlying things are, or constituents would say, institutional investors tend to settle positions and go away. And are they leaving the market, therefore, slightly more, if you like, to retail investors? Sentiment for that time of year is clearly much more positive. We also have a big thing in the US, the pension deadline and bonuses are paid. So again, there's increased flows from retail investors. And, people do launch predictions for 2025. So you do generally see quite, much higher flows. So there is, if you like, some evidence supporting that theory of higher chance of positive flows during the time.
Well, I'm talking about 2025 and predictions. What's your sense? I mean, it's been quite a good year, particularly in the United States. What's your sense of what 2025 holds?
I mean, it's been an excellent year, and long may it continue. Markets being up over 20%, Nasdaq hitting 20,000. The AI story carries on, and 2025 it will be very hard to sort of start talking against that. Also, does the US story carry on? Well, you've got a new president coming over in America in January, and he's very supportive of stock markets. So certainly, I would say the short-term momentum for the US carries on. But you've also got to look at things that haven't done well, and predictions for 25 are always notoriously hard. But I wouldn't write off Asia, specifically parts of Asia and the Far East, perhaps for perhaps stopping this US dominance that we've had over the last 10 years.
Okay, Jonathan, trying to do a previous guest with an even more festive background. Thank you very much indeed for joining us, Jonathan Webster-Smith. Okay, you're watching Business Live. Take a quick break. Up next, it is the markets today. FTSE up just a fraction. All the details after this quick break.
What's it like doing this kind of stuff when he's not here?
Yeah, I miss him. He just inspired me to be a better person. He's shown us what living looks like in the toughest and most difficult of circumstances.
I'm Greg Milam, and I'm Sky's Chief North of England correspondent.
Mandatory evacuation, you must leave!
For many people, Harvey is far from over. People here believe the water will be this deep for weeks. I've reported from around the world and around the UK. It isn't what politicians see from election battle buses, but what ordinary people see from the buses that shape the timetable of their lives.
I feel like there's no trust between the people and the politicians.
Labour's going to get in definitely, and they're no better than the Conservatives.
It is almost impossible to predict where these fires will go next. Ida has certainly left its mark on New Orleans.
It just feels heartbreaking.
Cartels in Mexico are flooding America with the drug. We are standing on the supply line right into the heart of America's opioid crisis. This gives you an idea of the strength of those winds, strong enough to bend and twist metal. Sky News, the full story first. Christchurch has been changed forever by what happened here.
There was a river of blood coming out of the mosque. That's a scene that you don't forget.
Are you trying to run me over, Sir Philip?
No, go away.
Look like it, sir. Will you respond to those who made accusations, Sir Philip?
Can you go away?
Very good morning to you all. Morning.
Do you regret the tweet, Gary?
There's no sign, publicly at least, of either side being willing to give ground. Brianna's dad told Sky News what he thinks of them.
If I'm honest, I hate them. They're just evil. They'll always be monsters.
Free wherever you get your news. How do you reassure the public that all of these mistakes wouldn't be made again?
God forbid we should have to do this again. Play Sky News.
From the Sky News Centre at 7.
Now that you're up to date, we can go into a bit more detail.
Things can change incredibly quickly.
Taken by surprise.
Have you ever known a moment like this in British politics before? Yes. Cheers.
We'll start with breaking news.
Let's get the latest on the ground.
So, by the end, we'll hopefully all understand what's going on in the world just that little better.
You want to talk business? Meet me in the on-board lounge. Fly better. Thank you.
Welcome back. Let's have a look at the markets on this Thursday morning. And Asia-Pacific indices mostly rose overnight following gains on Wall Street. So the Nasdaq Composite surged to record levels after November's inflation report met expectations. In Europe, markets have moved slightly lower as regional investors await this year's final monetary policy decision from the ECB. Meanwhile, the Swiss National Bank also cut rates today by 50 base points, exceeding expectations of a smaller trim and an ongoing tussle with depressed inflation and a strong Swiss franc. Here in London, the FTSE's largely unchanged, but helped by the drinks giant Diageo shares in the parent company of Guinness, Baileys and Johnny Walker staging a comeback after falling to an historic low last month. The share price surge comes after an upgrade in a UBS analyst note published yesterday. Let's have a look at the currencies. The pound is down a little today after a 8-year high against the euro yesterday. It's still at 121, but just down a fraction. Also down just a smidgen against the dollar at 127. And the price of oil is essentially unchanged. Let's speak to Rachel Winter, who joins us this morning. Rachel, very good morning to you. Can we start with Currys, if we can, because they're also doing very well this morning, up 11%.
Yeah, great share prices moved this morning. So we had results this morning. The company announced an earnings increase of 52%, so really, really good numbers there. This actually is a company that's on a bit of a rebound. So it really struggled between 2021 and 2023 because of the cost of living crisis and because people were cutting back on their spending on electronics. But over the last year, that's really turned around and now the business seems to be doing very well. It's increasing profits and it's increasing its margins as well.
Yeah, good old Currys. And of course, a busy time of the year for them. With Christmas just around the corner. Also a good day, it seems, for European defence shares.
Yeah, so there's been some discussion among European members of NATO about raising their spending targets. So at the moment, members of NATO are supposed to spend 2% of their GDP on defence. In practice, a lot of them are actually quite a way behind that. However, Trump has been threatening to take the US out of NATO, and that would put more pressure on US countries to spend more on defence. So there has been this discussion over the last week about European countries spending up to 3% of their GDP on defence, and that's been good news for European defence shares today.
I say, Rachel, we're quite close to Christmas, but we're also quite close to kind of 3 big interest rate decisions, most notably coming up from the ECB as well.
Yeah, so Europe is struggling at the moment, so it is expected that the European Central Bank will be cutting interest rates, probably from 3.25 down to 3%. So that would be good news for European equities, hopefully.
OK, and just very finally, let's talk about the Nasdaq Composite. What is that? Because it's hit a record high, but just explain to our viewers, you know, why it's done that.
So it's one of the most popular stock indices in the US. It's simply a way of measuring how the US market is performing. And the Nasdaq Composite is one that's very heavily focused on US tech companies. It has had a very good rise over the last year. In fact, it's up over 130% over the last 5 years. But the reason for the recent rally is an expectation of interest rates in the US coming down. So as you said earlier, The inflation data from the US that came out yesterday was in line with expectations, and that makes it likely that the Federal Reserve in the US will be cutting interest rates next week. The expectation of that has been good news for equities, and therefore we've seen that NASDAQ composite moving higher.
Rachel, great stuff as always. Rachel Winter there from Killick & Co. Wealth Management. Thank you very much indeed for joining us. OK, we're just going to take you briefly to the House of Commons. The Housing Minister announcing some of the government's plans to change planning. Let's have a listen.
Going in the round to local plan support, planning capacity and capability support and other things. On migration, Madam Deputy Speaker, he knows as well as I do that the majority of homes that developers sell in this country are to British nationals, that most parts of the country have local allocation rules in place and local residency requirements that means that non-British nationals can't access housing, that only those who are eligible for no recourse to public funds can do so. He knows those rules. He's scaremongering. It's beneath him. I know that the honourable gentleman doesn't really believe it, and the House believes it either, Madam Deputy Speaker.
I call the Chair of the Select Committee, Florence Eshalabi.
Thank you, Madam Deputy Speaker. I welcome the greater detail on the changes to the NPPF that the Minister's outlined this morning. And he's right, we do have to be bold. As he's outlined, the social housing sector is in crisis.
There you go, a brief taste of what the government are announcing in regards to changing the planning laws. There'll be more on that on the afternoon edition of Business Live, of course, at 4:30 this afternoon. And indeed, up next with Jane Sacker, who's got the very latest news headlines at midday. Stay tuned for that. I'll see you a little later on this afternoon.